Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at Target and Walmart stock ahead of their upcoming Q1 earnings releases to see if either of these big retailers are worth buying and maybe holding beyond their upcoming releases. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into Target and Walmart, as I'd like to do every week, I want to just take a broader look at the market and where we are, especially given the craziness we saw last week. So the S&P 500 and the Dow both suffered their toughest three-day stretches since October last week as inflation fears mounted. The benchmark index and the blue chip indexes both then regained momentum and closed Friday within approximately 1.5 and 2% respectively of their records from the week before. So we saw buyers step in and have the S&P 500 finding support at its 50-day moving average then on Thursday. Meanwhile, with the NASDAQ, it also jumped for the second day in a row to end the week to stop some of that bleeding after it had tumbled nearly 8% from its April 26 records, with the tech-heavy index now sitting at about 5% below those recent highs. That said, all three indexes then did slip Monday again following that big end-of-week positivity, which kind of makes sense at this moment. So the main culprit behind all of that volatility last week was inflation, with the consumer price index up about 4.2% in April from a year earlier. This was the largest 12-month jump since the summer of 2008, and it came in above expectations. The jump in prices also followed a 2.6% pop in March. So these new figures forced the selling on the back of fears that the Fed might need to raise its interest rates to tamp down rising prices. The prospect of these higher interest rates also spooked technology investors in particular. Wall Street is clearly growing more concerned about inflation amid the U.S. economic resurgence, which is being boosted by the vaccine push, pent-up demand, as well as easy money policies and those government checks. Yet the Fed remains steadfast that inflation will be what it calls transitory and retreat later this year, since prices are currently being compared to those early shocks of the coronavirus last year and are being made worse by supply chain setbacks. The Fed has also continued to voice its commitment to its ultra low rates, and its new average inflation targeting means that the central bank will allow inflation to run above its 2% target for some period of time. So amid these inflation fears and the possibility of an end to the easy money policies, it's worth remembering that even if rates do climb, they will likely remain historically low, forcing that continuation of there is no alternative, or that TINA investing. So the market clearly never just goes up. Wall Street is always going to take a chance to take profits. So, for instance, the NASDAQ has already recovered from a correction in 2021 that was actually sparked, if it seems like forever ago, sparked by earlier inflation worries back in February. Clearly, everyone needs to remain pretty vigilant on the inflation front, but the prospect of about 6.5% U.S. GDP growth, which would be the largest in over 35 years, coupled with the improving earnings outlook in the broader economic reopening, with over 40% of U.S. adults now fully vaccinated, sets up a bullish outlook for the rest of 2021. And we should note that those April sales figures, retail sales figures, came in flat from March, so that's relatively a positive sign that there's not another huge jump. Maybe could push prices up even higher, but still, those figures are up big since March. March's figure was revised upwards to about 11%, which was continued to be driven by those stimulus checks. So big sales growth in April. We should note that a decent amount of that growth in April was for auto purchases, and then as well as spending at restaurants and bars. So good for those hard hit industries to have a bit of a comeback on that front. And now I'm quickly going to take a look at just the broader earnings picture that we have at Zacks before we then jump right into Walmart and then Target. So overall, the Q1 S&P 500 earnings are expected to be up a whopping 47% from the relatively easier to compare periods last year on about 10% higher revenue, which is really impressive. And then we're calling for Q2 to be up 53% on the bottom line and 17% on the top line, with then continued growth after that. So really impressive growth. And then for overall 2021, we're calling for about 33% bottom line growth on about 10% higher revenue for the S&P 500, with then 12% growth expected in 2022. on 6.5% higher revenue. So continuing to grow next year as well. So with this in mind, we're now going to jump into Walmart. Walmart shares are down about 9% from their late 2020 records heading into its first quarter FY 2022 financial release that is due out on Tuesday, May 18th. So before the market opens, actually tomorrow morning or Tuesday morning, the 18th. So the retail giant is coming off one of its strongest performances in years driven by the coronavirus. But the tough comparisons seem to set up a bit of worry at the moment on Wall Street. But we'll see what's going on as we just take a little quick broad view of what's going on with the retail giant. So Walmart posted one of its best performances in years last year with sales up 7% during its FY21 as consumers flocked to Walmart, Target, Costco, and other one-stop shop retailers during the heart of the pandemic. Walmart's U.S. comparable sales surged 9%, with its e-commerce revenue up a whopping 80% as well last year. So just a massive, impressive year for the company last year. Walmart also pushed deeper into e-commerce overall, well before the pandemic, which helped it really do very well last year. As it tries to keep pace with Amazon, the company now has multiple delivery and pickup options. And in mid-September, so last September, it launched its subscription service to further challenge that Seattle giant. The service, which is dubbed Walmart Plus, costs $98 a year versus Amazon Prime's $119 and offers unlimited free deliveries. Members also get discounts on fuel and access to some different in-store checkout offerings as well. Walmart has also expanded its customer base and diversified its portfolio as smaller brands continue to thrive online. So Walmart's efforts on this front include teaming up with secondhand clothing firm ThredUp, which actually went public, as well as partnering with Shopify to bring more small businesses to its own third-party marketplace. Walmart is also beefing up its digital advertising business, and it said last quarter that, quote, its rapidly growing advertising platform should be a multi-billion-dollar business in the very near future. And then back in January, the company announced a partnership with investment firm Ribbit Capital to create a new fintech startup to help boost its broader financial service offerings. And then most recently on May 6th, Walmart entered into an agreement to acquire MEMD, so MEMD. The deal is set to help it provide access to virtual telehealth across the country and complement its in-person Walmart health services. So as it jumps into that booming telehealth business. So despite all of these positives, Walmart started to slip late last year, and it fell further after it missed its Q4 estimates and provided relatively disappointing guidance back in February. And clearly, as we mentioned earlier, it's competing against a very unprecedented, hard to compare year. So it's FY 2022 sales. So this year's sales are projected to dip about 2.6%, with its adjusted earnings expected to slip 1%. Obviously, Wall Street understands that these tough comparisons lie ahead, and the stock lands at a Zacks Ranked over 3 hold at the moment, along with an overall A VGM score. Plus, its 1.6% dividend yield roughly matches the 10-year U.S. Treasury. On top of that, Walmart stock has doubled its industry and slightly outpaced the S&P 500 over the last 5 years, up about 135%, a trend that's continued recently as well. And at the moment, it's trading at around $140 a share, which is about 8% below, or 8 to 9% below, depending on what, if you look at a closing price or its intraday high, from its where it was last year. And it sits right at neutral RSI levels at the moment, so it could give it room to run. And we should note that 16 of the 20 brokerage recommendations that Zacks has for Walmart are either strong buys or buys, with the other 4 at a hold. So broader brokerage positivity for this massive retail giant. And obviously, Walmart is hardly that flashy stock anymore. Those big growth days are hard when you're pulling in $500 billion. But Walmart is a retail titan that's clearly prepared for the future and willing to adapt. Therefore, investors looking for a safe dividend-paying stock to add to their portfolio might want to consider Walmart as a long-term buy and hold candidate. That's one of the big, huge players in the retail world. Amid all of the changing things, Walmart's going to be around for years and years and years to come. So now we're going to move on to another big retailer that's a Walmart rival, and that is Target, which trades under the ticker TGT. and it is set to report its Q1 FY 2021 financial results before the market opens on Wednesday, May 9th. So Walmart's reporting Tuesday before the opening bell, and Target's set to release Wednesday before the opening bell. So just like with Walmart, we're going to kind of go over the broader steps Target's taken to stand out in this retail industry. So Target's e-commerce boom has helped it thrive during the heart of the pandemic, and as we enter into the more of the normal lives we can hope to live going forward, as consumers look for as many ways, in different ways as possible to shop during the coronavirus. So this includes same-day offerings such as in-store pickup, drive up, its subscription-style shipped unit, which allows shoppers to go in kind of and pick out your stuff and then bring it to your house for you. The Minneapolis-based retailer also continued to attract customers through on-trend and affordable fashion, home decor, furniture, food, and much more. So Target also continues to partner with designers on everything, as we mentioned, from fashion to furniture, and its flagship grocery brand, which is that Good & Gather brand, has continued to perform very well since it hit the market, alongside many of its upscale aiming in-house brands that have continued to help it sort of stand out among certain demographics compared to its main rival, Walmart. Target has also successfully positioned itself as a fantastic one-stop shop option, and it's been able to grow despite Amazon's continued and constant pressure on the industry as a whole. And as we just mentioned, it's been able to separate itself from Walmart and Costco within some key demographics through its various partnerships and on-trend offerings from, as we mentioned, fashion to clothing and everything beyond. So Target's 2020 sales surged a whopping 20%, with comps up over 19%. This huge top-line growth was driven by 7% in-store comparable sales expansion and then 145% boom on the digital front. Its adjusted earnings also surged nearly 50% last year, and it has consistently topped our bottom line estimates. With this in mind, Target's 2021 sales and earnings are projected to slip slightly against those nearly impossible to compete against 2020 figures. Still, the company's Q1 revenue, so its upcoming revenue, is projected to jump 10%, which is impressive considering Target sales in the year-ago period actually jumped 11%. Meanwhile, its adjusted Q1 earnings are projected to soar over 250%. Target's earnings per share revisions help it land a Zacks rank number 2 buy at the moment, alongside an A grade for growth and Bs for value and momentum in our Styles Core system. Target's margins are also slightly better, and sometimes much better than its rivals, Walmart and Amazon, and it's been able to thrive and keep its costs relatively low despite its e-commerce push, as it's able to fulfill most of its sales via its own store, so it doesn't need to have warehouses all over the place. Target stock has also blown away Walmart in the S&P 500 in the last 3 years. It's up about 200%, including a roughly 70% run in the last 12 months. Obviously, though, the stock has cooled down a bit recently. The stock still outpaced, though, the benchmark in 2021 at around $210 a share. Target sits about 4% below its May highs, and it comes in near neutral RSI levels at the moment at around 55. The company is also trading at a discount compared to its industry at the moment, and it provides income as well. Its dividend yield is currently at about 1.3%, which tops its industry's 0.8% average and roughly matches the S&P 500's average at the moment as well. And we should note that 14 of the 19 brokerage recommendations that Zacks has for the stock are strong buys, with none below a hold. We should also note that really heading into its upcoming release, the company's seen a lot of positive bottom line revision positivity. So the Zacks most accurate estimate, which is the most recent estimate that we have heading into its release, is up 21% from our overall consensus estimate for Q1. So the most accurate estimate is sitting at $2.55 per share compared to our current consensus estimate of $2.11 per share. So clearly, analysts with some of the most up-to-date estimates are calling for far higher sales or far higher earnings, which will be a very positive sign for Target, especially in the near term. But like with both these stocks, if you're looking to play just around earnings, always risky. But you couldn't really go wrong with either of these stocks as long-term buy and hold investments, as they're just going to be dominant retail players in a retail space that's being crowded out continually by these big box retailers and Amazon. And both Walmart and Target have really prepared for the future with that booming digital commerce business and all of their various delivery and pickup options that people have really come to love. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.